Well, the U.S. banks have struggled since the collapse of Silicon Valley Bank. The index that tracks the sector is still down over 15% year to date. And while Canadian banks have underperformed the benchmark index, they have not underperformed the situation in the U.S. But one thing is emerging. We have seen the Canadian banks with U.S. exposure show some signs of struggling. Let's bring in Gerard Cassidy. He's Managing Director and Head of U.S. Bank Equity Strategy at RBC Capital Markets. And still on the desk with us is Mark McQueen. Gerard, thanks so much for being with us. I know you're the U.S. bank analyst, but as we take a look at the Canadian banks, we're showing that the U.S. exposure is just as challenged as what we're seeing from some of the other U.S. banks. Walk us through how you're thinking about that.
Sure, Amber. When you take a look at what's going on here in the United States, and you're seeing it in other banking markets around the globe, actually, it all has to do with the interest rate environment by the central banks. And as you know, here in the United States, the Federal Reserve has taken its monetary policy to a very strong tightening mode. It's easing up a bit now that we think it's approaching its terminal rate for the Fed fund rate increases. But what's happened is that, similar to past tightening cycles, this is the part of the cycle where the banks have to pass on more of the interest rate increases from the Fed onto their depositors, which weighs on the net interest margin. And that was quite obvious in the second quarter results. And that will still continue to weigh over the near term on the margins. So that's the biggest challenge we're seeing amongst the banks, and that's probably true as well for the U.S. operations of the Canadian banks, is that to grow deposits, you're having to pay up for them.
The TD Bank share price chart, which has obviously got a huge exposure in the United States, looks a lot like Bank of America and Citi. And yet JP Morgan obviously has had a whole other experience the last 6 months. And what's going on? There are four very big global banks with lots of choices and capital to deploy, and yet three kind of are not doing so well, and one's had a blowout year from what I can tell.
Yeah, no, Mark, it's a good point that you're making, that JP Morgan has really outperformed. When we travel visiting our clients around the world, JP Morgan's always the go-to name. So if you're a bank investor in Singapore or London or Toronto or New York, and you need to have some U.S. bank exposure, and you're not certain whether you want to overweight your exposure to the U.S. banking sector, JP Morgan is the go-to name. So it is a name that's very well owned around the world, deservedly so. When you look at the performance that under Jamie Dimon's leadership, since he took over as CEO well over 10 years ago, he has really delivered some very strong results for his shareholders, and that's showing up this year as well. The diversity of revenue is a key factor here. Also, there was, following the Silicon Valley and other bank failures, a flight to the larger banks, and certainly JP Morgan benefited from that. And of course, they were selected to buy the First Republic Bank from the FDIC, which was a huge win for JP Morgan. So they've been executing very effectively. They got diversified revenue. They've got a global presence, and that has shown up in the stock performance this year.
Where's your conviction these days? Are you picking up Citi, which has rolled over meaningfully back to levels that we haven't seen since the fall of 2022? Are you trafficking more in the regional space, which, jitters have been resumed on the back of some of these debt downgrades?
You're bringing up some interesting points, Amber, especially on the debt downgrades, because we were a bit surprised in the timing of the Moody's, S&P, and Fitch downgrades. We would have thought they would have done this maybe last fall. It seems like the horse is out of the barn. This is all well known, what's going on with the banking fundamentals. That being said, however, when you take a look at the past tightening cycles, the terminal rate for Fed funds, when it reaches its peak, and there's talk about it possibly reaching a peak in the fall, and the Fed will then stop raising short-term interest rates. Following that period, around 3 to 6 months after that period, deposit rates for the U.S. banks stop going up. And at the same time, the cash flows from their asset side of the balance sheet from the securities portfolio, those cash flows are invested at higher yields, and the net interest margin pressure is alleviated and margins start to improve. So I think what you're going to see is that if the Fed is at its terminal rate in the next 2 to 3 months, and we have a soft landing in the U.S. economy next year, the banks, like the regional banks, and as well as money centers like Bank of America, are the names investors can look to own under that kind of scenario. Now, Citi, as you might imagine, they're a global bank. About 55% of their revenues come from outside the United States. So it's not as much as a pure play on the U.S. And then also, as we all know, right now, they're trying to turn it under the leadership of Jane. She's trying to turn that ship around. It's a big ocean liner. It takes a long time for them to turn it around, but she's making some progress.
The Canadian banks, by and large, have big exposures in the U.S. BMO has Bank of the West. RBC has City National. Each had tough times in the last 2 weeks, and I think the prior quarter, too. The excuse has been around commercial real estate and strip malls and whatnot. And what are you seeing in the big U.S. banks that might give us some hints about what's coming for the Canadians there?
The commercial real estate markets are certainly feeling the adverse effects of the rise in interest rates, as well as the dynamic work from home that we're seeing following the pandemic. And the work from home dynamic is still present, particularly in our large urban markets, such as San Francisco, Los Angeles, Chicago, and New York. And so the office real estate market is currently the market that is the most of concern, particularly in what we call the Class B and C buildings. These are the lesser quality buildings versus the Class A towers that most of the big cities, of course, have. That being said, we think it's going to be interesting because due to the fact that the shadow banking industry has been so strong in the United States, and they have taken absorbed a good portion of this commercial real estate market for the large office projects. So when you see the owners, like Brookfield, for example, handing back the keys, so to speak, to the lenders on its big Los Angeles property, which it did around 6 months ago, when you look at the lenders, it's the CMBS market, commercial mortgage-backed security market, which is a market that is, throughout the world. And so there's no real concentration in the banks. Where the banks are going to have the challenge is when they have to refinance cash flowing properties that are in good shape, but the values of the properties have come down and the interest rate on the mortgages have gone up, and that's going to cause some difficulties in refinancing that property without more equity being contributed by the owners, or they're going to have to structure a deal where they'll get different tranches of debt. But overall, the commercial real estate markets are under pressure. We don't disagree with that. We think it's manageable for the U.S. banking industry because the exposures are not excessive. And with the weakest and most damaging area, and it's going to be very tough, the downtown office markets, most of that exposure right now is not with the largest banks, but with the shadow banking industry, which again is through the CMBS market.
So this is what's so confusing, because if the concentrations aren't large within the banking sector, and they've already done a bunch of provisions, whether general or specific, for the sector, why are we all worried about it?
I think it's really the unknown. And it comes down to... But
you mentioned some points that are all very well known. That's the thing. We've been talking about them for the better part of, 6 or 8 months, and yet we're still worried about them. And I not to tease you, but it's just such a quandary.
Yeah, no, great questions. I would say that the unknown on the economic outlook, but not on the real estate. I'm with you on the real estate. The challenges are there, they're known, but it really is worrisome. What if we go into a hard landing in the United States? And just to kind of define hard landing, if you say a soft landing is unemployment in this country, which, as you know, is under 4%, the unemployment rate. Let's assume in a soft landing, the unemployment rate goes to 4.5% to 5%. In a hard landing, it goes to north of 8%. In a north of 8% market, unemployment rate, that is, then the real estate market gets hit even harder. Then the properties that are cash flowing favorably today could even have problems. And it's a two-tiered problem in the commercial real estate market. One is the actual defaults, handing back the keys, as I mentioned, versus just the refinancing risk. And the refinancing risk is present for all properties, not just downtown office. But to your point, and that's why the stocks trade where they do, because I think the stocks have already discounted much of this challenge. And it really is going to come down to, I think, the Fed hitting that terminal rate. And once they hit the terminal rate and the rates stop going higher, then I think that's when the banks really will start to work over the next 12 to 18 months, assuming, of course, the Fed reaches its terminal rate sometime in either September or November of this year.
All right.